Today, I'm going to walk you through 5 mistakes that people make over and over again with their 401k. One of them cost somebody that I know personally over $50,000 in taxes. And some of these mistakes seem perfectly logical when you execute them, but with 2020 hindsight, you realize that something has gone horribly wrong. Before we get into the actual mistakes, I want to frame what the issue is, because a lot of people don't even know that there's an issue. The issue, frankly, is that how you save money when you're working and how you spend money when you retire are not the same. Yet people believe that the way that the process that they use to contribute to their 401k should look similar to the process that they use when they withdraw money from their 401k. And nothing could be further from the truth. And the reason is that the government creates special tax rules for a 401k that allow you to take a tax deduction when the money goes in, but you have to pay taxes on it on the way out. I think most of you know that, but I have to say it because if somebody doesn't understand this, well, it will have a huge impact on their quality of life when they do enter retirement. A recent Vanguard study shows that smart management of a 401k increases income from that 401k by 4% annually. With that as the backdrop, let's get into it. 5 mistakes that can cost you dearly in retirement. And we'll start with the biggest one of all. In fact, 55% of the people who enter retirement with a 401k make this mistake. Mistake number 1, leaving your 401k with your old employer. Many employees leave their money with their previous employer because it's easy. This happens a lot, particularly if the retiree left the previous organization on good terms and they feel great about the organization. And many employees think it's a simple choice. It worked in the past, so let's not reinvent the wheel here. Let's just leave it there. But it is not a simple choice at all. In fact, frankly, leaving your funds in your employer's 401k reduces flexibility, reduces visibility, and you probably will pay more in fees than you would if you took the money from your old 401k and put it into an IRA. Combine that with the fact that your former employer could merge with another company, change plan choices, or do something else which is completely out of your control to affect the performance of the 401k, your 401k. And with limited investment options and fees that can be 1% to 2% in many cases, many, even most ex-employees remove the money from their employer's 401k, their previous employer's 401k, and they put it into an IRA. The other aspect is you miss the opportunity to align your retirement accounts into one tax strategy. If you have an account here and an account there, the two together may or may not work well together, so to speak. But when you put them in one location, you can optimize the investments and how you take distributions from that one vehicle. And finally, consolidating into one IRA makes it a lot easier to manage required minimum distributions when the time comes. The only exception I can think of is if you're retiring before age 59 and a half. If you are retiring before age 59 and a half, leaving some of your funds in the 401k will allow you to access those funds in certain circumstances. Mistake number 2, taking money out without a withdrawal strategy. Without a strategic plan, withdrawing money from your 401k could put you into a higher tax bracket. This in turn triggers thousands of dollars of extra taxes that could have been avoided simply by understanding the timing of these withdrawals. Some retirees don't realize that taking money out of their 401k too quickly pushes them into a higher tax bracket, and had they just waited even a few months, crossing over from one year to the next, they could have saved themselves 10% in some cases in tax penalties. But it also goes the other way. Some retirees are too conservative withdrawing money from their 401k, missing the opportunity to take funds out at a lower tax bracket because they haven't had a lot of spending activity in the year that they would take the funds out. A smart tax strategy considers current and future tax brackets, your Social Security withdrawal strategy, and Medicare surcharges. The ideal approach often involves taking money out between the time you retire and the year before you reach your required minimum distribution age, so that you don't pay taxes unnecessarily when the RMDs kick in. It's often good to work with a financial planner to get the balance right between your 401k, your Social Security strategy, and Medicare surcharges. Gang, there's been a lot of negative news in the press lately about certain Medicare brokerage firms that have steered clients towards the companies that pay them the most, not the companies that are best for the clients. It's important to note here that we do a lot of due diligence on the companies that we represent to you, that we bring to you. And we're very proud of these companies. We've done a lot of work to make sure that they're vetted. And one of those companies is Chapter. Chapter is a Medicare advisor that has access to 24,000 plans, saves their clients an average of $1,100 per year, and they're totally free to you. So if you have questions about Medicare, or you just want a second opinion, give them a call at the number on the screen, 440-703-1224, to see if they can help you. I'll also put the number in the description below so that you don't need to stop the video. Mistake number 3, ignoring required minimum distributions. The IRS requires you to withdraw funds from your 401k or your IRA once you reach a certain age. That age depends on when you were born. But if you ignore this, you're going to pay a big penalty because they want their tax money, to be completely candid. Your RMD is based on your account balance and your life expectancy, and it generally increases as a percentage of your account balance as you get older. If you miss the December 31st withdrawal date or you don't take enough out, the IRS can penalize you up to 25% of the amount of money that you should have taken out. This is one of the harshest penalties in the tax code. Many retirees also fail to realize that different retirement accounts have different RMD requirements. A 401k is different than an IRA, and an IRA is different than an inherited IRA, for example. So set up automatic RMDs through your 401k provider or your IRA custodian, and also put a reminder in your calendar in October of every year so that you don't forget. This simple step takes about 15 minutes a year, and it can save you thousands in IRS penalties. It will also keep you in good standing with the IRS, which is always a good idea. Mistake number 4, overconverting to a Roth IRA. Roth conversions can be one of the most powerful actions in retirement tax planning, helping you create tax-free income streams and reducing future RMDs. But I frequently see retirees move too much too quickly, thinking that they're being tax savvy by putting everything into a Roth. Large conversions can trigger a cascade of consequences: higher taxes, Medicare surcharges, Social Security taxation. Those are just 3 of many that can happen if you convert too much too quickly. These combined effects can cost you a lot more than you ever would have paid with an RMD, which defeats the purpose of a Roth conversion in the first place. Instead, if you don't need the money, just fill the lowest tax brackets with each conversion, for example. This bracket filling approach spreads your Roth conversions over multiple years, reduces your minimum taxes, and still reduces your RMDs when the time comes. Mistake number 5, forgetting to update your beneficiaries. Now, this one can be devastating because your current wishes may be different than your previous wishes, and you won't have time to undo it, unfortunately. Too many retirees believe that their will or trust allocates who gets what when their time has come, but the beneficiary form that you filled out with your 401k or your IRA overrides what is in your will. Major life events like marriage, divorce, births, deaths, or change in relationship status can mean that what you put on that form, when you put it on the form, isn't applicable today. If your form lists someone who's no longer part of your financial plans, the money still will go to them regardless of what you actually want today. This one mistake can cause family conflicts, unnecessary taxes, lost inheritances, and other issues that you don't really want simply because you didn't change a form. The solution: check your beneficiary designations on your retirement accounts at least once a year. So what's your action plan? Consider rolling over old 401ks into an IRA for more control, better investment options, and potentially lower fees. But check for any unique benefits in your plan first. Second, create a year-by-year withdrawal strategy that considers tax brackets, Social Security, and Medicare thresholds before you need the money, not when you're already taking withdrawals. Third, mark your calendar now for future RMDs and consider setting up automatic distributions through your financial institution to avoid costly penalties. Fourth, approach Roth conversions strategically by filling tax brackets slowly over multiple years rather than rushing to convert everything at once and triggering unnecessary taxes. And fifth, review all your retirement account beneficiary forms today and after any major life change to ensure that they still reflect your current wishes and family situation. Remember to treat your 401k like a powerful tool that needs active guidance, not as a treasure chest that needs to be locked away until someday happens. The decisions you make today will echo through your retirement years, creating more freedom and options. If you like this video, check out that video, the RMD mistake that 84% of retirees make. This is Jeff Schmidt, and I will see you in that video right there.
Holy Schmidt!